Here I am using multiple time frame on Forex, but this works for stocks, commodities, futures, options, whatever you want to trade. So using multiple time frames is very common, and I do recommend it, and I do employ it myself. However, one of the biggest mistakes that I see lots and lots of traders doing is using a ratio of the time frames that are way too far apart. So, for example, this is spot Forex. So we've got a 60-minute chart on the left and a daily chart on the right. That is a 1 to 24-hour ratio. So we're going to have 24 bars on the 60-minute chart for every 1 bar on the daily. Well, that's a huge problem. I do not recommend that you do that because that is going to be very, very lagging. So now if you're trading stocks, for example, then it doesn't trade necessarily 24 hours. And so basically open outcry is 6.5 hours. You'd have a 1 to 6.5 ratio between the two charts. Still, to me, not tightly correlated enough. The timing is not synchronized tightly enough. And so your signals, what people normally do is they look for confirmation. They like to trade in the direction of trend of the longer term time frame. Well, you're going to have a late signal, a late confirmation, really late. So I like to tighten those up. So let's just look at a couple of examples here so you can see exactly what I'm talking about. So I've got a 14-period ADX here, just, again, no magic to the 14-period ADX, but people usually like to confirm with trend on the higher time frame, and trend is commonly measured by the ADX. A lot of people do that anyway. So here we would see the threshold of 20 being broken on both time frames at the same time. But if you bought this, of course, you can see for yourself, the market continues to go down, 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 down. Then, and look, let's also look at this here. So as I move my crosshairs over, look on the daily chart and see when it moves to the next bar. I'm moving all these bars over on the 60-minute chart, and it's not, all this happens, all that price activity happens, until I hit literally that bar right there. And that is when the ADX actually gets above the threshold of 20. And in the meantime, it's going down. Well, what... I mean, first of all, psychologically, that's going to be really challenging to deal with, right? So if you get in, the market moves against you, then you're freaking out. And number two, it just wasn't a good confirmation anyway. Now the point is, okay, you say, well, I look at the daily chart, and it is going above the ADX. So some people do it the opposite way. They say, well, I look for the entry on the daily chart, and I look for then a more precise entry on the 60-minute. So I'm looking for my setup on the daily. Now I've got it. ADX is above 20, and now I want my signal over here on the 60-minute. Well, now the ADX has already moved up on the 60-minute chart, and it's moving back down, so we've got to wait for it to get back below the threshold of 20. The problem is it actually keeps going up, even though the ADX is going down. So the market's going up, and you're missing out on all that. And now you're frustrated. That's another psychological challenge, is the frustration of the market moving all the way up there without you ever getting a new trigger on the short-term chart. And so, dang, that's really annoying. All right, so let's move forward here. Let's see where we get our next signal. So there it is. So ADX gets back above 20 here. And actually, again, it's above 20 on both time frames. So that looks good, right? Looks great, except for, again, same problem. On the 60-minute chart, the market actually goes down, and we're stuck with the psychological challenge of hanging in there while the market moves against us, watching our P&L go red, and it's not an optimal entry. It is not a very precise, accurate entry. If you want, it comes down, 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 down. So either you got stopped out or you're mentally suffering while the market moves against you. And now, okay, well, actually, we get, yeah, we have that signal there. It goes against us, comes back down. Look what happens on the 60-minute chart. Comes back down below our threshold of 20. So now we don't want to get in. We got to wait. We got to wait. We got to wait. We got to wait. Okay, and now it comes back up above. And so, okay, now we get another signal. But look at all the profit we left behind us now. So we're getting in like midway in the move. And this, again, is going to mess up not only our win-loss ratio, but our risk-reward ratio. Because we're getting in so late that our, one of the most common sayings in trading is keep your losses small, let your winners run. And we're not doing either one of those with this technique. Our losses are either big, or we're allowing them to be big because we didn't know if that market was going to come and turn back up. It could have continue down, and then our losses would be really, really big. And we don't have, now that we get a signal to go long again on the 60-minute chart, we're halfway through this move. And so we are not letting our winners run because we're not getting in at a low enough point in order to get a nice reward, a big win. And so, yep, it goes up, and we make a little bit on that one. Okay, that's fine, but it's not optimal, is it? It's not optimal. And that's the point, is to optimize our entries. So again, we get another long signal here, and yeah, ADX is above 20, but again, if you bought there, it moves down, makes lower lows, and then, it's just a mess. It's a mess. Why is it a mess? You're dealing with a 1 to 24 ratio. And so your signals on the long-term chart are not going to give you, or either way, whether you're starting with the setups on the long-term chart or starting with setups on the short-term chart, the two are not giving you timely signals. And so it messes up everything in your trading. Your risk-reward ratio, your win-loss ratio, your psychology of having to hang in there while the one market moves. And even a 6 or a 1 to 6 ratio is not good enough. I used to trade 1 to 4 ratios between the two charts, and that worked pretty good. But my favorite now is 1 to 3 ratio. And I find that that works very, very well. So when you're setting up your charts, whatever time frames you're using, to me, the optimal ratio between your two charts is 1 to 3. And I have found that that gives me very timely confirmations. The signals on the two time frames are very tightly correlated so that I don't have to sit there and suffer through the volatility of waiting for one chart to catch up with the other. So if you like this video, if you found it helpful, understand that, yep, of course it's free, but there's a moral rule in the universe that if you get something good, you should what? Pay it forward. We've all heard that. So if you did like the video, then go ahead and please, the best thing you can do is just click on the share button. Share it with others. That's how you literally pay it forward, is to share it with others. And also you can click the thumbs up icon. I love that. And I especially love your comments. So that really encourages me to continue to create more free tutorials for you. So just any nice little comment you want to type in there or question, I'd be happy to receive those. Also, as a special gift to you, I'm giving away one of my favorite trade strategies. I call it the rubber band trade, and it has a very, very high win-loss ratio. I'll give it to you absolutely free, and it's a 26-minute video, and you can get that by just clicking on the image in the top right corner of this video, or there's a link in the description below the video. You can click on that too. And if you're not watching on YouTube, there's probably a link below or an opt-in form.